Good morning everyone, I'm Ken, Financial Analyst for Regain Capital, and welcome to our morning market briefing on the 6th of November, Friday. So as usual, in our market briefing, we will cover three parts, namely the fundamentals, the news release, and the technical analysis. So without further ado, let's start off with the fundamentals. When we take a look at yesterday's market movement, we can see gold surging by 2.45%, followed by a surge in the pound against the dollar as much as 1.22%. The dollar index tumbled by 0.91%, and oil also falling lower by 1.58%. So let's get into further details with the headlines of today. First off, let's cover a bit on the equities and the gold market, where we can see both have actually surged on Thursday following a weaker dollar as the 2020 US election comes to an end. Now, the safe haven gold broke above its key resistance at 1950 to reach more than a 1-month high on expectations that further stimulus will be issued regardless of the winner. So furthermore, with countries globally extending their loose monetary policies and supplying large amount of money into the market, gold was highly demanded as a hedging instrument. So instruments involved would be gold itself. And moving on, let's cover a bit on the dollar, where we can see the dollar index extended losses further on Thursday as the US election comes to an end, while uncertainties fade and expectations of further stimulus grew. Now this has actually boosted investors' risk appetite, which caused yesterday's shift from the dollar market into risky assets such as the euro and the pound. Now, furthermore, the Fed's policy meeting also failed to provide support for the dollar after it concluded with the same stance for an extensive loose policy ahead. Now, with elections aside, investors today will also turn their attention to the job reports from the United States, namely the unemployment rate and also the non-farm payroll, to gauge the latest labor market conditions. So instruments involved here would be dollar index and major currency pairing against the dollar. So moving on, let's take a look at the news release for today. So please take note, time stated here are GMT plus 8. So today's data will all be at 9:30 PM. So the first one would be from the US, which is the non-farm payrolls and unemployment rate. So for the non-farm payrolls, it is expected to fall lower from previous month of 661,000 to 595,000. Now, although the number of jobs creation is still at a high figure, however, we can see that the data is gradually decreasing from monthly, thus signaling that the impact of the coronavirus might be affecting the labor market. Furthermore, unemployment rate is expected to fall from previous month of 7.9% to 7.7%. So overall, we would wait for both of the data to see how the overall labor market is performing in terms of the private sector and the whole country. So a higher reading for the NFP will provide support for the dollar, whereas a lower unemployment rate would provide support for the dollar. And at the same time, Canada will also be releasing its jobs data, namely the employment change and also unemployment rate. So for the employment change, we can see a major change from previous month of 378 to now only a forecasted 59,000. So overall, this decrease shows the impact of the coronavirus towards Canada's labor market, where it's affected heavily with jobs creation being less and unemployment rate remaining at the same 9%. So overall, the labor market in Canada isn't looking very good, and any reading for the employment change, lower reading would exert pressure on the Canadian dollar, whereas a higher unemployment rate would exert pressure on the Canadian dollar as well. So that is all for our news release. Moving on, let's take a look at the technicals. So here's an overview of instruments to be covered. First off, US dollar Swiss franc H4 chart showing a downtrend. Canadian dollar against Japanese yen H4 chart also in the downtrend. For the GBP US dollar H4 chart showing an uptrend, and for the gold in the H4 chart also signaling an uptrend. So let's take a look at the chart analysis, starting with the US dollar Swiss franc. Constructing the Fibonacci from the previous high towards the low, we can see that the pair has actually faced some rejection from the 0.0 Fibonacci near 0.9030, and currently is showing some signs of rebound. However, overall trend in terms of the daily chart is still in a very strong bearish, where this support level at 0.9030 plays a very important role to determine whether or not the pair is able to fall lower. However, in the daily chart, if we are looking at it, a support level can also be formed at the previous point over here, close to 0.9000. So overall, cautious investors are advised to wait for the breakout below the 0.0 Fibonacci to get further confirmation on whether or not the pair is able to extend its long-term downtrend. So a breakout below suggests cautious investors to consider short positions near 0.9030. Stop loss should be placed 30 pips from the level or 40 pips from the level at 0.9070, and a take profit of about 80 pips at 0.8920. Or aggressive investors can wait for some retracement back towards the 23.6 Fibonacci before entering into short positions following the long-term downtrend. So cautious investors can consider waiting, or to wait for a breakout, or to wait for a retracement to enter a short market, whereas for aggressive investors can consider long positions if the pair fails to break below the 0.0 Fibonacci. Stop loss should be placed below at 0.9000. Take profit can be set towards the 23.6 Fibonacci at 0.9090. Next, for the Canadian dollar against Japanese yen. Now, constructing Fibonacci from the high over here towards the low point, we can see that the pair is currently has been rejected from the 50.0 Fibonacci near 79.8, and also breaking below the 38.2 Fibonacci at 79.3. So MACD showing a bearish momentum suggests the pair to extend lower towards the 23.6 Fibonacci at 78.8. So overall, investors can consider short positions at the current level 79.25 or 79.3. Stop loss should be placed 30 pips from the 38.2 at 79.6, and a take profit targeted all the way towards the 23.6 Fibonacci as the first target profit at 78.8, and a further target would be the previous support zone over here at 78.5. However, if the pair managed to break back above the 38.2 Fibonacci, investors are then advised to consider long positions. Stop loss should be placed below the 38.2 Fibonacci, and the take profit target at 50.0 Fibonacci and the 61.8 Fibonacci. Next, for the GBP US dollar H4 chart. Now, also constructing the Fibonacci from the high over here towards the lowest point, we can see that the pair is currently testing near towards the 61.8 Fibonacci at 1.3160. So MACD signaling a bullish momentum suggests the pair to extend higher after successfully breaking above the 61.8 Fibonacci. Now, after breakout, a resistance point can be seen close towards the 1.3260 level. So cautious investors are advised to consider long positions after the breakout at 1.3170. Stop loss should be placed 40 pips from the level at 1.3130, and a take profit targeted all the way towards the resistance at 1.3260. Whereas for aggressive investors, if the pair fails to break above the 61.8, aggressive investors can consider short positions. Stop loss should be placed 30 pips from the 61.8 Fibonacci, and take profit targeted at the 50.0 Fibonacci near 1.3070. Lastly, for gold in this H4 chart. Now, gold has broke below its previous downtrend. Now, looking at a longer time frame, we can see a longer extended downward trend line over here, and gold has successfully broken above, with MACD signaling a strong bullish momentum, suggesting the gold to extend higher all the way towards the previous resistance at close to 1970. So overall, after the long extended gains, the gold will most likely find some retracement back before continuing its further trend. Now, the targeted entry point would be at 1930. So Cautious investors are advised to wait for a retracement back towards the resistance near 1930 before entering into long positions. Stop loss should be placed 100 pips from the level close to 1920, or to be even safe, back below towards the trend line near 1910, and a take profit targeted all the way towards the resistance reach here at 1950, or a longer term target would be at 1970. So do take note that investment for gold is a high risk investment, and due to the current fundamentals, which is the elections where results will most likely be announced either today or next week, so do expect large fluctuations in the gold market, and please use proper risk management in trading gold. So that is all for our market briefing. Please remember to follow us on our social media such as Facebook, Telegram, Twitter, as well as Instagram. And feel free to drop by our website at www.regaincapital.com to get updated on all the latest market news, as well as education posts for our clients. So thank you all for listening. We'll see you next week on our market briefing, and happy trading to all.